We often think that mastering personal finance is about unlocking some secret code, a set of intricate rules and strategies that only the experts truly understand.
Hmm.
But what if the real key to financial success isn't about what you know, but how you act?
I
That's the intriguing idea that jumps out right from the start of The Psychology of Money, one of the sources you shared with us.
That's a fascinating point to kick us off, and it's exactly what we're going to unpack today. You've sent us a really thought-provoking collection of excerpts from Morgan Housel's book.
Yeah,
Our aim is to go beyond the typical financial tips and explore those often overlooked psychological and behavioral forces.
hitting stuff.
Exactly. The stuff that has a surprisingly powerful impact on our financial lives.
Okay, so forget the day trading secrets for a moment. Let's consider the story of Ronald Read. His background, as described, is pretty remarkable.
Right.
A philanthropist, investor, and someone who worked as a janitor and a gas station attendant.
An unassuming background, to say the least. Born into a rural community, he was the first in his family to graduate high school,
Wow.
which involved hitchhiking to campus daily,
Yeah.
apparently a testament to his determination.
Incredible.
Now, think about the typical image of someone who achieves great financial success. Often, we picture someone with an elite education, top-tier connections.
Right, the usual
It's
suspects.
the kind of profile you might associate with someone like Richard Fiscone, who is mentioned in the book as a contrasting example, though his specific details aren't really the focus.
So this raises a really compelling question. How could someone with Ronald Read's life experiences,
Hmm.
I mean, a janitor and gas station attendant, ultimately become a philanthropist and a successful investor?
Yeah, how?
Very likely outperforming individuals with all the traditional advantages in the financial world. What's the dynamic at play here?
What makes this so interesting is how unusual this kind of outcome is in fields outside of finance.
Right.
Could you imagine someone with no medical training performing a more successful surgery than a leading cardiac surgeon?
No way.
Or a self-taught individual designing a better skyscraper than a team of renowned architects?
It seems almost impossible in those professions. You wouldn't expect a layperson to suddenly outperform top engineers.
Not at all.
So, what is it about finance that allows someone like Ronald Read to not only participate, but sometimes excel, seemingly against all odds, alongside those with the conventional markers of financial expertise?
Well, the book proposes a couple of key ideas. One, which we'll definitely explore further, is the element of luck.
Okay.
Financial results aren't solely determined by intellect and effort, but the second, and perhaps more insightful explanation, is that navigating money successfully is fundamentally a soft skill.
Soft skill like managing emotions.
Exactly. It's less about mastering complex financial instruments and more about understanding and managing your own behaviors,
Yeah.
your psychology.
Okay, let's delve into this idea of how you behave. One of the things that really struck me in the book is the profound way our individual past experiences shape our entire relationship with money.
Oh, completely.
It's not just about numbers on a screen. It's deeply connected to our personal history.
Exactly. The book provides some really vivid examples. Think about the completely different perspectives on money held by someone who grew up in poverty versus someone who was raised in affluence.
Worlds apart.
Their fundamental understanding of risk and reward, of scarcity and abundance, will be worlds apart. Or consider the impact of living through a period of high inflation.
Yeah, watching your savings just melt away.
Right. Compared to a time of stable prices,
Yeah.
those kinds of formative experiences leave a lasting imprint on how people view and handle their finances.
Right. Someone who lived through the Great Depression, for instance, will likely have a fundamentally different approach to saving and investing than someone who came of age during the dot-com boom of the late 1990s.
Totally different mindset.
And the book even points out how something as simple as your geographical location can have a significant impact. Someone living in Australia, which hasn't experienced a recession in decades,
Lucky them.
will have a financial outlook that's hard for someone from a country with more volatile economic cycles to fully grasp. Your financial worldview isn't universal truth. It's a product of your unique economic upbringing. You've got to recognize this bias.
What's so significant is that these diverse life histories lead to genuinely different financial goals, beliefs, and even predictions about the future.
Makes sense.
And it's not necessarily a matter of who is more intelligent or who has access to better data. It's the lens through which they interpret the financial world.
They're personal filters.
A lens shaped by their own particular journey, Yes.
That makes perfect sense. And it really resonated with me when the book quoted Michael Batnick saying, some lessons have to be experienced before they can be understood.
Oh, that's so true.
You can read all about market volatility, but actually navigating your investments through a downturn is a completely different kind of education.
Precisely. And this isn't just anecdotal observation. The book refers to research by economists Melmandir and Nagel, who analyzed decades of American financial data.
Okay, what did they find?
Their significant finding was that an individual investor's willingness to take on financial risk is strongly correlated with their personal history.
Not their IQ.
Not primarily, no. Specifically, their past experiences with market returns, rather than just their IQ or financial literacy. It's the dumb luck, as the book puts it, of when and where you happen to be born that can heavily influence your financial instincts.
Wow.
Their research covering half a century of American finances definitively showed that past experiences, not just education, dictate how much risk people are willing to take. It really challenges that purely rational view of investor behavior.
It even touches on how the career of the famous bond investor Bill Gross coincided almost perfectly with a long-term decline in interest rates.
Yeah, a massive tailwind.
This trend provided a major tailwind for bond prices throughout his career. He himself acknowledged that his perspective on bonds as reliable wealth generators was likely a product of that specific era.
Right, because falling rates make existing bonds with higher coupons more valuable.
Exactly. So if he had started his career even a decade earlier or later, his views might have been quite different. His entire perspective on bonds was shaped by that era.
It's a reminder to beware of applying lessons learned in one economic era to another. Your experiences shape your perception, but the rules of the game can change. For Gross, bonds were largely a source of gains.
Whereas for someone else,
Right, for someone who lived through periods of much higher inflation, bonds might have been seen as a way to preserve capital, not necessarily grow it significantly. The book further illustrates this by pointing out the vastly different stock market experiences of people born in 1970 versus those born in 1950 during their formative young adult years.
It's incredible to think that two groups of people, born just 20 years apart, could develop such different fundamental beliefs about how the stock market operates.
And then you consider the really extreme historical examples, like the devastation of the German and Japanese stock markets during World War II.
Whole wipeout for many.
Essentially wiping out wealth for many compared to the U.S. market, which actually saw significant growth during the same period. Those kinds of starkly different experiences would shape financial perspectives for generations.
Yeah, absolutely.
And that's a key insight. Everyone is operating with their own unique mental framework for understanding the financial world.
Their own little bubble of experience.
And that framework is built on the very limited snapshot of global financial history they've personally witnessed.
Right. So while someone might be making what appears to be a financially unsound decision, it's crucial to appreciate that their choices might actually make sense when viewed through the lens of their individual history and their particular way of seeing the world.
Precisely. You might not agree with their logic. The book uses the example of someone buying lottery tickets despite being in debt, but you can at least begin to understand the underlying motivations and the psychological factors at play.
Yeah, you can see why they might do it, even if you wouldn't.
And all of this influences financial decisions made in social settings, from casual conversations to formal business meetings, where factors far beyond pure data and spreadsheets come into play, all filtered through our individual experiences.
It even made me consider something I hadn't really thought about before. The relatively recent idea of widespread retirement.
Oh, yeah.
Before World War II, the expectation for most people was simply to work until they were no longer physically able.
Right. Work till you drop, basically.
The concept of a substantial period of life after work, funded by savings and pensions, is a comparatively modern development.
What's fascinating here is how quickly societal expectations around something like retirement can become deeply ingrained, even though they are historically quite recent.
It's true.
This really highlights how much our current financial landscape and our assumptions about it are shaped by events and trends that are, in the grand scheme of things, relatively new.
Okay, so we've explored how our personal histories shape our financial views.
Mhm.
Now let's turn our attention to another significant theme in the book, the interplay of luck and risk.
Ah, yes.
It's something we often struggle to acknowledge, isn't it? Especially when discussing financial success.
That's right. We tend to favor narratives of skill and hard work as the primary drivers of achievement. Seems more controllable.
Yeah.
However, the book makes a compelling case for the substantial and often indistinguishable roles that luck and risk play in financial outcomes.
Mhm.
Think about iconic figures like Bill Gates or the Vanderbilt family.
Sure.
Their success is undeniable, but how much of it was due to exceptional skill versus being in the right industry at the right time? It's often incredibly difficult to separate the two.
And the boundary between bold action and reckless gambling can be incredibly fine.
Oh, razor thin.
When things turn out well, we often label it as visionary genius.
Yeah.
When they don't, it's easily dismissed as foolishness.
The book uses Benjamin Graham's substantial investment in Geico as a prime example. By his own admission, it went against many of his own well-established rules of diversification.
Really? Even Graham?
Yeah. Was it brilliant foresight or simply a stroke of good fortune? Even he questioned his ability to definitively tell the difference.
Wow.
Exactly. And the book offers other thought-provoking examples, such as Mark Zuckerberg's decision to turn down Yahoo's billion-dollar acquisition offer.
Which seemed crazy at the time to some.
Right. Versus Yahoo's later rejection of Microsoft's much larger bid. Looking back, one decision appears brilliant, the other misguided.
Hindsight is 20/20.
But at the time, both involved significant risk and a degree of uncertainty about the future. What clear, universally applicable lesson can an entrepreneur truly extract from those contrasting outcomes when luck played such a significant role?
It really underscores how challenging it can be to draw definitive lessons from both successes and failures. Because failure, particularly when it results from unforeseen external factors, can lead you to incorrectly conclude that a fundamentally sound decision was actually flawed.
That's right.
The book aptly calls this the unforgiving realities of risk.
That's a crucial point. Even the most well-thought-out strategies can experience temporary setbacks due to factors beyond our control. This is why building a financial foundation that can withstand those inevitable storms is so critical.
Resilience.
It's about having the resilience to remain in the game long enough for probabilities to eventually work in your favor.
It brings to mind the story John Bogle shared.
Oh, the Joseph Heller one.
Yes, about a billionaire who had made more money in a single day than Joseph Heller had earned from his classic novel Catch-22 throughout its entire history.
And Heller's response?
Heller's response was simply, yes, but I have something he will never have. Enough.
Powerful.
It introduces this vital concept of recognizing when you have sufficient resources and why the relentless pursuit of more can be detrimental.
That's a profoundly important idea, and the book explores it through the cautionary tale of Rajat Gupta.
Right, the former McKinsey head.
Here is a man who, by all conventional measures, had achieved extraordinary success. The head of McKinsey, immense wealth, philanthropic endeavors alongside Bill Gates, board positions on major corporations.
He had it all, basically.
By 2008, his net worth was estimated to be around $100 million, an amount most people can only dream of.
Absolutely. He had reached a point where he could have pursued virtually any interest or passion. But apparently for Gupta, that wasn't sufficient.
No.
He harbored a desire to become a billionaire. And it was this relentless pursuit of more that ultimately led him to engage in illegal insider trading activities related to Warren Buffett's investment in Goldman Sachs.
What's so striking about Gupta's story, and the parallel example of Bernie Madoff also mentioned in the book, is that they had already attained levels of wealth, prestige, and freedom that most of us would consider unimaginable.
Yeah, why risk it?
And yet, they jeopardized it all in the pursuit of even greater riches, demonstrating a fundamental lack of that sense of enough.
It's a stark illustration of how an insatiable appetite for more can lead to incredibly damaging consequences.
Definitely.
The book even references the collapse of the hedge fund long-term capital management.
Oh, the Nobel laureates.
Right, a firm populated by Nobel laureates and incredibly wealthy traders who, in their relentless quest for higher returns, took on such excessive risk that they ultimately suffered catastrophic losses.
Exactly. The book argues that understanding enough isn't about being financially conservative or missing out on potential opportunities.
It's not about being timid.
No, it's about recognizing the inherent dangers of perpetually chasing more and understanding that, much like overeating, you eventually reach a point where the potential downsides far outweigh any marginal gains.
The point of diminishing returns or even negative returns.
Precisely. Some individuals, unfortunately, only grasp this lesson after experiencing significant setbacks.
So we've considered personal history, the impact of luck and risk, and the crucial concept of enough. Now let's shift our focus to something that often operates quietly in the background, but has a tremendous impact over time. Compounding.
Ah, yes, compounding and the importance of patience.
The eighth wonder of the world,
Yeah.
supposedly.
Well, it's truly remarkable the power of compounding, that gradual, often unnoticed process that can yield astonishing results over the long run.
Yeah.
The book uses a compelling analogy of ice ages.
Ice ages, how does that relate?
It explains how seemingly small, consistent changes in temperature, just a little more snow accumulating each year, not melting away, can eventually lead to massive ice sheets covering entire continents over geological timescale.
Okay, I see. Small changes, massive results over time.
Exactly. It's a brilliant way to visualize compounding in finance, where small, consistent gains reinvested over time generate increasingly larger future
The
gains.
snowball effect.
Precisely. The essential ingredient, of course, is time. And the book really emphasizes this by comparing the investment journeys of Warren Buffett and Jim Simons.
Okay, the Oracle of Omaha versus the Quant King.
Right. Jim Simons, the founder of Renaissance Technologies, has achieved truly exceptional average annual investment returns, significantly surpassing Buffett.
Higher returns, yeah.
However, Buffett's overall net worth is vastly greater. The key difference:
Time.
time. Buffett began investing at a young age and has had many more decades to allow the power of compounding to work its magic. Even with somewhat lower average returns, that significantly longer time horizon makes all the difference.
It really highlights how counterintuitive exponential growth can be compared to our natural linear thinking.
Totally.
We can easily grasp the concept of adding 8 plus 8 plus 8, but the idea of 8 multiplied by itself numerous times, it's much harder for our brains to intuitively grasp.
Our intuition fails us there.
And the book suggests that this lack of intuitive understanding is a major reason why we often underestimate the potential of compounding and instead focus on other, often less effective, strategies for building wealth.
That's right. We're constantly bombarded with information about short-term market fluctuations and complex trading strategies.
The exciting stuff.
But the most fundamental element, consistent investing over a long period, is almost too simple and, frankly, too boring to capture our attention.
Yeah.
The book even playfully suggests that the most important investing book might simply be titled Shut Up and Wait, containing nothing but a long-term chart of economic growth.
It's so true. We often seek out complex solutions when the most powerful force at play is simply the passage of time and consistent action. And this lack of intuitive understanding of compounding likely contributes to many disappointing trading experiences and unsuccessful attempts to get rich quickly.
Absolutely. People are naturally drawn to the allure of high returns as it feels like the fastest path to wealth. But they often overlook the foundational importance of simply remaining invested in the market long enough for the exponential growth of compounding to truly take effect.
Which leads us seamlessly to the next crucial point: the vital importance of survival in the financial arena.
Staying in the game.
Exactly. The book contrasts the experiences of Jesse Livermore, who famously made a fortune during the 1929 crash, only to later lose it all,
Yeah, tragic story.
with individuals who were also ruined by the same crash. It underscores that accumulating wealth and preserving wealth are distinctly different skill sets.
That's a critical distinction. As Nassim Taleb wisely put it, having an edge and surviving are two different things. The first requires the second. You need to avoid ruin at all costs.
Avoid blowing up.
Right. The book outlines 3 essential aspects of adopting a survival-first mindset in finance.
Okay, let's hear what those are.
First, prioritizing financial resilience and the ability to withstand setbacks over the pursuit of outsized returns. Consistent, good returns maintained over the long term, particularly through turbulent periods, will ultimately lead to better outcomes.
Slow and steady wins the race.
Kind of, yeah. Second, while planning is important, it's even more crucial to plan for the reality that your plans will inevitably be disrupted. Unexpected events are a constant in life.
Absolutely. No one possesses a perfect crystal ball to predict the future. Stuff happens.
And the third key aspect is the indispensable concept of margin of safety.
Margin of safety, what does that look like?
This manifests in various forms: maintaining a frugal budget, cultivating flexible thinking, and adopting a longer-term perspective. Essentially anything that provides you with a buffer.
A cushion.
Yes, a cushion to navigate a range of potential outcomes without facing financial devastation. It's like planning for your home renovation to cost 15% more than the initial estimate. That buffer helps you handle unexpected issues.
Got it. So margin of safety isn't about being overly cautious or leaving potential gains on the table.
Not necessarily.
It's about enhancing your probability of long-term success at any given level of risk by significantly improving your chances of weathering unforeseen challenges.
Exactly.
It implies that you don't need to possess an extraordinary edge if you have a substantial financial cushion to absorb potential shocks.
Precisely. It's about acknowledging that uncertainty is an inherent part of the financial landscape and proactively building in that room for error to absorb the inevitable surprises.
Like the card counter example.
Right. It's similar to a blackjack card counter who understands the odds are in their favor, but still needs sufficient capital to withstand inevitable losing streaks. In the financial realm, absolute certainty is an illusion.
And the book aptly points out how history is replete with examples of good ideas that were pursued to excess.
Taken too far.
The wisdom lies in having that built-in buffer to absorb unexpected shocks and prevent temporary setbacks from becoming permanent disasters. It reminds me of the common tendency to underestimate costs and timelines for things like home renovations.
Oh, yeah, the planning fallacy.
We often plan for the ideal scenario and are then caught off guard by unforeseen complications.
That's a perfect analogy. Margin of safety allows you to weather those unforeseen setbacks and remain in the game long enough for low probability but potentially highly rewarding events to occur.
The tail events we'll probably talk about.
Exactly. Often the most significant gains materialize infrequently or take considerable time to compound. That financial cushion is what enables you to stay invested and benefit from those opportunities.
It also touches on the dangers of making overly precise financial projections, such as retirement forecasts that rely on a specific, unchanging rate of return.
Yeah, assuming 8% every single year forever.
Right. Life inevitably throws curveballs. Markets experience volatility. You might need to access your funds unexpectedly.
So you need that buffer.
Building in a margin of safety, such as assuming more conservative future returns and increasing your savings rate, provides that crucial buffer against the unexpected.
And the book strongly cautions against the risks associated with excessive leverage, taking on too much debt.
Leverage cuts both ways.
It certainly does. While leverage can amplify gains during favorable periods, it can also transform ordinary risks into catastrophic events, masking the potential for ruin during times of optimism.
It makes small problems potentially fatal.
Right. It's like the historical account mentioned of German tanks in World War II being disabled by something as small as mice.
Mice.
Apparently, you simply can't anticipate every potential risk, and those unforeseen events can sometimes be the most damaging.
It really emphasizes the importance of building redundancy into our financial lives, rather than relying solely on a single source of income.
Diversification beyond just stocks and bonds.
Saving without a specific purpose in mind can act as that vital safety net against life's many unpredictable events, the financial equivalent of ensuring multiple layers of defense.
Absolutely, because the most critical aspect of any financial plan is acknowledging and preparing for the fact that your plan will likely not unfold exactly as you initially envisioned.
Plan for the plan to fail, basically.
Mm.
Okay, now, another fascinating psychological aspect that the book delves into is the pervasive power of pessimism.
Ah, pessimism. It always sounds smarter, doesn't it?
It really does seem like negative news in the financial world always captures more attention and carries more weight.
It truly does. The book argues that pessimism often carries an inherent air of seriousness and intellectualism, making it sound inherently more plausible and insightful than optimism.
But it defines optimism differently, right?
Yes, it clarifies that true optimism isn't about blindly believing that everything will always be wonderful. Rather, it's a rational belief that the probabilities of a positive outcome are in your favor over the long term,
Despite the bumps.
despite the inevitable setbacks and challenges along the way. It's fundamentally about understanding that most people are generally working towards making things better.
Yet, we tend to grant so much more credibility to pessimistic forecasts, even those that seem quite extreme.
Oh, yeah.
The book uses the example of a Russian professor who predicted the disintegration of the United States,
I remember that.
a prediction that actually made the front page of the Wall Street Journal. You rarely see similarly outlandish, optimistic predictions receiving that level of serious attention.
That's a fantastic observation. Imagine someone in post-World War II Japan confidently predicting that within a generation, Japanese companies would own some of the most prestigious real estate in the United States,
Unthinkable at the time.
and that Americans would be eagerly studying and trying to emulate their economic strategies. It sounds almost far-fetched, yet that's essentially what transpired. Pessimism just seems to have this innate intellectual allure.
And the investment newsletter industry seems to, in many ways, thrive on this tendency, often populated by voices of doom and gloom,
The perma bears.
despite the long-term upward trend of the market. The book quotes both Matt Ridley and Hans Rosling on this inherent human inclination towards negativity and our tendency to perceive the world as more dangerous and hopeless than it actually is.
It's a built-in bias, maybe evolutionary.
Could be.
There are several compelling reasons why financial pessimism is so widespread and persuasive. Firstly, money is something that affects everyone.
Universal concern.
So negative news related to finances tends to grab universal attention and trigger a strong emotional response. Secondly, progress in many areas, including the economy, often happens slowly and incrementally, making it easy to overlook.
Like watching grass grow.
Exactly. Setbacks, on the other hand, are usually rapid and dramatic, instantly demanding our focus. Think about the Wright brothers' first successful flight. It took years for the world to fully grasp its revolutionary significance.
Good point. Crashes are fast, growth is slow.
And the book provides a really powerful analogy of an alien observing Times Square in both 2007 and 2009. On the surface, to an outsider, the scene would appear largely the same. The bright lights, the bustling crowds, the towering billboards. The alien wouldn't see the underlying economic turmoil
The financial crisis happening behind the scenes.
and the trillions of dollars in household wealth that had vanished during that period. It brilliantly illustrates how significant economic shifts can be invisible on the surface, while market downturns are keenly felt and widely reported.
That's a great analogy.
Exactly. The high stakes involved in personal finance also contribute to the persuasiveness of those predicting doom. People crave certainty and a sense of control over their financial future, even if it's an illusion.
We want answers, even wrong ones sometimes.
And because each of us operates with our own limited understanding of the complex global economy, our interpretations of financial events can be flawed, leading to overconfidence in our own views.
Thinking we know more than we do.
And making us more susceptible to compelling, pessimistic narratives that seem to offer a sense of explanation and prediction.
It all makes sense why there's such a persistent demand for market forecasts, even though their historical accuracy is, to put it mildly, questionable.
Yeah, understatement.
It taps into that fundamental human need to feel like we inhabit a predictable world. As the book points out, we tend to focus on the information we have readily available and often neglect the vast unknown,
Focusing illusion.
leading to overconfidence in our ability to foresee future events. We're all, in a way, like that alien in Times Square with an incomplete picture of the intricate forces at play.
Absolutely. And this leads us to another crucial concept: the importance of tailoring financial advice to the specific individual.
Right, no one size fits all.
The book draws an insightful parallel with the evolution of medicine,
How so?
which has moved from a more paternalistic doctor knows best approach to a more patient-centered model where different treatment options are presented and the patient's preferences and values are given significant weight.
Okay, the doctor gives options, the patient decides based on their values.
Exactly. It's a really apt analogy. Financial guidance shouldn't be a generic prescription.
Yeah.
A financial advisor can provide valuable knowledge, data, and probabilities, but ultimately, the most suitable path forward is entirely dependent on the individual's unique financial goals, their specific circumstances, their risk tolerance, and what truly brings them financial peace of mind.
What lets them sleep at night?
Precisely.
Oh.
No one can definitively tell you exactly what you should do with your money without a deep understanding of your personal time horizon, your comfort level with market fluctuations, and what you ultimately hope to achieve with your financial resources.
So that generalized advice.
It has its limits. While sometimes helpful, it can only go so far. It needs personalization.
To bring in together all these fascinating ideas, what are some of the core takeaways for our listener from this deep dive into the psychology of money? What are the key insights that you think will really stick with them?
Oh, there are so many. The book is full of valuable lessons, but several core principles really stand out. First, cultivate humility in your financial dealings.
Less ego.
Yes, less ego often translates to more wealth. Savings are fundamentally the gap between your ego and your income. That's a big one.
About that framing.
Second, prioritize managing your money in a way that allows you to sleep soundly at night.
The sleep at night test.
The optimal financial strategy is the one you can consistently adhere to over the long term. If it keeps you up worrying, it's probably not right for you, even if it looks good on paper.
Definitely. And I think the book's emphasis on the value of controlling your own time is incredibly important.
Huge.
It argues that the ability to use your time as you see fit is the highest dividend that money can ultimately pay.
Absolutely. And beyond the purely financial aspects, strive to be kind and avoid unnecessary displays of wealth.
Be nice, don't be flashy.
Basically, true respect and admiration tend to come from qualities like kindness and empathy, not from material possessions.
hmm
And, of course, the foundational principle, save consistently. Just save.
Save, period.
Save for both your known future goals and for the inevitable unexpected events that life throws our way.
And it's crucial to recognize that achieving worthwhile financial goals often comes with a price, right?
Yes, define the cost and be ready to pay it.
In the realm of investing, that price often manifests as volatility, uncertainty, and even moments of doubt or regret. You need to be mentally prepared to pay that inherent fee.
And absolutely prioritize building in a significant margin of safety, worship room for error, as the book says.
Worship it. Strong word.
Well, maybe strong, but it emphasizes the importance. Endurance and the ability to withstand setbacks are fundamental to harnessing the power of compounding over the long run.
Gotta survive to compound.
Exactly. Finally, aim for balance in your financial decisions and avoid the extreme ends of the spectrum. Adopting a balanced approach increases the likelihood of sticking with your plan as your life circumstances and priorities evolve.
Makes sense. On a personal level, for me, my primary financial objective has always been financial independence. Yeah, having the freedom to do what I want, when I want, with whom I want, for as long as I want. And this book really reinforced the idea that achieving this kind of independence is driven far more by maintaining a healthy savings rate
Control what you can control.
and keeping my lifestyle expectations in check than by chasing after the absolute highest investment returns. My family has always been quite good at keeping our lifestyle desires relatively stable.
Resisting lifestyle creep.
And we found that many of the things we truly enjoy are actually quite low cost. Going for walks, reading, that kind of thing.
That's a really insightful, personal example of aligning your financial decisions with your core values and aspirations. It fits with the book's point about reasonable versus purely rational.
How so?
Well, the book touches on seemingly irrational decisions, like choosing to own a home outright without a mortgage, while not always the most mathematically optimized choice in a low interest rate environment.
Right, the math might say invest the difference.
It can be a psychologically sound or reasonable decision that prioritizes peace of mind and reduces financial stress. It's about recognizing and prioritizing what truly matters to you personally.
Exactly. And for me, a significant part of that is proactively saving for the unexpected, those inevitable curveballs that life inevitably throws.
The emergency fund, and then some.
My own investment strategy is fairly straightforward. Consistently investing in low-cost, broadly diversified index funds for the long term. I don't feel the need to try and be the world's greatest investor.
You don't need to beat the market.
I simply need to be consistent and patient to reach my personal goal of financial independence.
That brings us to a final reflection. Looking at a period of significant economic upheaval and transformation, such as the post-World War II era in the United States.
A huge shift.
The book briefly touches upon this period of unprecedented economic growth, shifting wealth dynamics, and evolving attitudes towards saving and spending. What's truly remarkable is how unpredictable and often counterintuitive those major economic shifts really are in hindsight.
Yeah, you couldn't have predicted it all.
Any attempt to construct a perfectly reasonable narrative of how it all unfolded would likely miss many of the key unforeseen factors.
It's a powerful reminder that the economy is cyclical and driven by a multitude of complex and often unpredictable forces. The post-war boom, fueled by factors like the fear of a return to Depression-era conditions, low interest rates that encourage consumerism, pent-up demand from the war years, and a more equitable distribution of economic gains,
A unique confluence of factors.
created a unique economic landscape marked by a rapid increase in household debt alongside strong income growth. It was manageable then.
And that post-war cultural emphasis on a certain degree of lifestyle equality, while initially powerful, eventually came into tension with the increasing income inequality that began in the 1970s and accelerated in subsequent decades.
Right. Incomes diverged, but spending tried to keep up.
Exactly, leading to a big stretch in spending and a significant rise in household debt, particularly among lower income households, as people sought to maintain similar consumption patterns despite diverging income trajectories.
Trying to keep up with the Joneses, even when the Joneses were pulling away financially.
It really underscores how economic realities and deeply ingrained cultural expectations are constantly interacting and evolving in complex ways.
It truly feels like, as the book quotes, history is just one damn thing after another.
Uh-huh. Yeah, that sums it up pretty well sometimes.
So to bring our discussion to a close, our deep dive into the psychology of money has revealed that achieving financial success is about so much more than just mastering financial concepts.
It's way beyond the spreadsheets.
It's profoundly influenced by our individual behaviors, our unique personal histories, how we navigate the unpredictable forces of risk and luck, understanding when enough is truly enough, the remarkable power of compounding and patience, the critical importance of financial survival, and our ability to navigate the often misleading narratives surrounding rare economic events.
And it's so important to remember that financial decisions that might seem irrational on the surface can often be understood when viewed through the lens of an individual's specific experiences and circumstances.
Have some empathy for seemingly crazy decisions.
Right. It highlights the significance of defining your own personal financial goals and time horizon and resisting the urge to compare yourself to others who are playing entirely different financial games.
Run your own race.
Exactly.
Well,
Ultimately, the book advocates for a reasonable and adaptable approach to managing your finances, one that acknowledges our inherent human psychology rather than striving for an unattainable ideal of purely rational decision-making.
be reasonable, not robotic.
Perfect.
So, for you, our listener, we hope this deep dive has sparked some reflection on your own financial journey and how your past experiences continue to shape your current perspectives and decisions.
And it leaves us with this final thought-provoking question. How can a deeper understanding of these often overlooked drivers of financial outcomes empower you to make more informed and personally aligned decisions in the future?
Your decisions.
Regardless of the inevitable ups and downs of the market or the constant external pressures of the financial world,